Dude, I guarantee you. So again, right? I bought a house at 150 on the way down, and my last one was at 28. Those are real numbers. The amount of people telling me not to buy my $28,000 house was more than the people telling me not to buy the 150. How freaking stupid is that? The lots were 70 grand.
Howdy. Welcome back to Dion Talk. Recently, I did a live stream on what my memory was of the cash flow in the first 10 years. Reaching financial freedom and making work optional and being able to walk away from a job that I like because time freedom eventually won out makes it easy to think in the now. And I've gotten several comments from people saying, well, what were those first few years like? Because we often talk, those first few years suck. It feels like it takes forever. So I did a live stream where I talked about the chronology out of memory, what I thought it was. And I am doing a video on looking at tax records and looking at income statements and W-2 forms and figuring out what the actual cash flow was. And I'm going to make that video.
But not today.
So what I have today is my two friends, Matt the Lumberjack Landlord and Michael Zuber from One Rental at a Time. Two people who also have reached financial freedom, made work completely optional, can do anything that they want to, and are taking their time, even though they can do anything they want to share with you how they did that so that you can do it too. Because that's the whole point of this, is to get you from the parking lot into the stands, to figure out what your strategies are, what you want to do, how you want to invest, and then get you on the field. So the purpose going forward, and maybe possibly a catchphrase, is to get in the game. But I want to talk to you guys just from memory, and you had no warning. I literally said, hey, here's the topic for today. No one's going to hold you to your numbers. Memory isn't perfect. If in the future you do a video where you go and you do what I'm going to do, it's going to take a couple of days of research to say, this is what actually happened. We're going to go, yeah, your memory kind of sucks, but this is what the timeline was. So let's start with Matt, who is suffering through a vacation in Vegas. Thank you for taking time out of your trip, and I will see you there soon.
Yeah.
The first 10 years. So you had your stock suck moment where you lost a bunch of money. I didn't mean to laugh, but we can look back now and laugh.
Yeah.
And you thought, okay, real estate's it. So those first 10 years, what did that look like cash flow wise?
Yeah. So, I mean, I started out house hacking. And so the first 3 years of my journey was, a $2,300 mortgage where I had a roommate paying $1,000 of it. And I could justify that size of a mortgage because I was driving 82 miles each way every day to work. And so the amount of gas and the time, the wear and tear on cars, and it was like, that was, $800-900 a month at that time. So when I looked at it and I said, okay, if I'm spending $800 or $900 a month right now on cars and gas and maintenance, and I can get a roommate in for $1,000 a month, and I'm going to be at $2,400 a month, I said, yeah, you know what, this makes sense. So I bought that place. I was around $1,300 a month out of pocket, but my real net increase was only about $400. And I was living in an awesome condo with a water view, kind of like the views that you show, which are absolutely amazing in your ad hoc live streams. But really, the first 10 years that was the first three. And then I bought a house. When we're talking about cash flows, I think year one, it was, basically just being able to live more lavishly on a whole lot less money. And then I think the next 3 years, so the first three, I would say was, about saving myself about $1,000 a month. So it wasn't even income. It was just saving myself $1,000 a month. The next 3 years, with my next rental, when I added one, I sold that condo and I bought a house and I was house hacking that. And so my mortgage was only $1,000, but I was getting like $600 for rent. So I was living on $400 again. So I was saving myself $600. But it was a minimalist approach. And then I started buying actual investment properties. And I think when it was all said and done, I think my net for the next 3 years, for the first three, it was just saving $1,000 a month. For the next three, it was maybe making an extra $2,000 a month. But almost all of that money was constantly being reinvested back in the business. And then the next 3 years is when it was the financial crisis. So the people that get to do it in 5 years and they get to start seeing results in 5 years, my first 10 sucked. They were horrible. It was slow. It was grueling. It was grindy. It was not making a lot of money. I think after I was 10 years in, I think we were probably making, at that point I was married, I was probably making only $5,000 or $6,000 a month net after 10 years, because we had gone through the whole great financial crisis and all that mess that was there. But I was building something better, and I was really growing and understanding what my skill set could be.
Can I ask really quick, Matt? You said how much was it at the 10 years?
Yeah, $5,000 or $6,000 a month. It wasn't a ton of money.
So only $5,000 or $6,000 a month in cash. So $60,000 a year coming in that you don't have to sell your life for. Whenever that sounds like it's terrible.
I know, it was the worst.
Right. So I just wanted to set a little expectation management there that, when you look at the numbers you've achieved, doesn't sound like a lot. For a lot of people, that's financial. It's definitely financial independence. It might not be the freedom point. Might not be that 4X rule where, yes, you can handle big, huge problems in life and not have to go back to work. Yeah. But it's right on the edge.
It really, and that was the thing, is really about 10 years in, it really was kind of on the edge. If I could continue to house hack, or if I could continue to just grow that business at the same normal clip, 10 years later or 5 years later, it was going to be amazing. But it's not to minimize the fact that getting to $60,000 in extra income isn't a phenomenal goal. It's just, for me, I thought differently. And I think that, the people that you find that end up really wealthy are the ones that measure their wealth the furthest out. So if you're talking 30 years out, and everything that I was doing, because I was so young, I was in my late 20s, early 30s, everything that I was doing was saying, hey, by the time I'm in my 60s, I don't want to ever have to work again, but I don't want to work again in my 40s, And so getting to that point was just kind of more a process for me, saying I wanted to build it to a point where I said, I can live on and do whatever I want and don't have to look at the price tag.
Two things there. The first, you talked about the financial crisis of 2008 really messing things up and delaying things. And so there are people who are investing now who could see a possible recession or housing crisis coming and might think that that's going to mess them up. And there's one shift that you have learned since then that would have made 2008 exponentially better for you.
Yes.
And that was in 2008. You rented primarily to construction workers because construction was booming and you knew they had money. They had a ton of money coming so they could pay their rent. Well, when that one industry took a hit, your entire portfolio did. So since then, you've learned to diversify your tenant base. So you have some Section 8. I go 1/3 military, 1/3 working and retired. And so if that's somebody's concern that could happen to you, that's why you're watching us. Exactly. So you can be ready for things like that.
Imagine the landlord that rented to crypto bros, like nothing but crypto guys. How'd you make your money, crypto? Oh, crap.
With the crypto row in Vegas. I mean, that's why you're going to look at houses.
I am. It's true.
Right. And the other thing is, I like how you said the person who thinks the furthest in the future generally tends to do the best wealth-wise. That's why I like the show Yellowstone. It's literally people who make decisions that impact decades. And my mind kind of works that way when it comes to money now. The further out your horizon is, the better it's going to go. Kind of like people saying, there could be a housing crash. Great, we'll buy more because I'm investing for cash flow and the value of the houses don't matter short term. Let's turn it over to Zuber. Those first 10 years, you, same thing, had the eye-opening moment of losing a ton of money in stocks. So very sorry for that. I didn't laugh this time. It's just a Matt thing.
And just like when we lose.
And then you decide, okay, I'm going to pull this last 40,000 because that's what's left in there. I'm going to pull it out and go into rentals. What do those first 10 years look like?
Yeah, really what I break it down, and most of this is in my book, One Rental at a Time. I kind of see 3 phases, which are right around 10, maybe 11 years. So the first phase was all single family homes, very much. I spent the first 3 years in my buy box. It's all I looked at. Then I go to a real estate meetup probably around year 4 and realize that California is in trouble, right? We are heading into unaffordability. It's where I learned about the affordability index. I went and researched Fresno and I said, oh my God, this thing's going to blow up. So those folks who think I never talk about a housing crash, again, read my book because I saw one coming. So right at the cusp, before we make a pivot, we have 6 houses in one duplex. The duplex is 2 houses on one lot. So I call it 8 homes, but it was 7 APNs. I think we were doing about $1,200, maybe $1,400. So not life-changing money. Certainly if you live in the Bay Area, it's a rounding error. Maybe if you're somewhere else, $1,000 is meaningful, but here it's just not. It's just not. But again, one of the things that's important to me was the ability to pivot and move around. So what we did is we took our, let's call it $1,000 for easy math. We over a 6 or 9 month period, we 1031'd out of all of our houses into apartments. So we go from 8 to 80. And I actually, in my book, I give you the math, right? All the buildings that made up the 80 units. There was a little bit of seasoning period on a couple of those, but by year 6 or 7, now we're in 80 units, maybe slightly more because we were still buying. But now we're up to thousands and thousands of dollars, right? At this point, my wife certainly could have retired, but she didn't because we were still building. Now the Great Recession happens, right? So unlike Matt, who felt it with his construction workers, I was pretty diversified. I had Section 8 and other income sources or other tenant income sources. So we had some pain, but it wasn't horrible. But we went out and started borrowing private money. It was the first time I borrowed millions of dollars from friends and family, and we just grew exponentially. So by the end of our 10-year period, we were hundreds of units and tens of thousands of dollars. But we consciously made several different pivots, right? That's why it annoys me when people say you're calling for house price appreciation because it benefits you. I'm like, no, it freaking doesn't, you idiots. I have a freaking Rolodex of people that will give me millions of dollars. I would love to buy again. I just don't see it. And it drives people crazy. So for me, it went from hundreds to thousands to tens of thousands. Probably at about year 12, it was probably tens of thousands. But for me, it was recycling capital. We're now sitting here with a decent sized portfolio, none of our own money in anything. So it's all infinite return at this point. It's all been recycled out and still cash flowing just fine. So it's a nice place to be, but it took time and a couple of, forks in the road that we decided to go a different direction. Because if we didn't, right, we stayed with those 8 homes. My homes went down 75%. They still cash flow, but $1,400. It wasn't going to move the needle. So we chose to go bigger via 1031.
What I love, I was around in 2008. I had been laid out from a police department. I was underwater on my house. I saw the housing market doing everything it was doing. And right now, we have a lot of people on the sidelines saying, I'm going to wait to invest until interest rates or prices or whatever happens that they want to happen. So they're waiting. So there's all these crash videos that are getting views. So people are sitting on the sidelines because a crash could happen. An actual crash did happen. And you were like, I'm buying everything.
Yeah, one of the things that was most important to me, and Olivia will tell you this, is when we were going through that, we had no idea how bad it was going to be. I bought the whole way down. One of the houses I bought was like 150 grand. The last one I bought was 28. I mean, that's real numbers. I didn't know where it was going to end. And the one thing I kept telling Olivia, I got a car note. My cars have been paid off always. I got a car note on both our cars because I wanted to go buy a more house. I had a bunch of silver and gold, sold it, bought more houses. I had no idea, but I knew one thing. I wasn't going to be one of those people that said, I wish I bought more. We bought everything physically possible. It worked out.
So in the last 10 years, while real estate was trending up, I mean, I have a unit count that I'm pretty comfortable at, but I wish I bought more. I think everyone wishes they bought more as it was trending up. When it starts trending down, if a crash started to happen and we don't see the metric that's going to cause all the forced sellers yet, I think there's a lot of people that will sit back and go, nope, I'm not catching a falling knife.
Dude, I guarantee you. So again, right, I bought a house at 150 on the way down, and my last one was at 28. Those are real numbers. The amount of people telling me not to buy my $28,000 house was more than the people telling me not to buy the 150. How freaking stupid is that? The lots were 70 grand. Right. I don't understand. I mean, I got in, like, when you get insurance, you have to get for replacement cost. My agent was asking me the last 3 years, what the hell are you doing? You have to insure this thing for 212 grand. You bought it for 28. Like, don't ask me. The bank sold it to me. I don't know. It's crazy.
It's trust in the asset class. And this video is, what did those first 10 years look like? And this will be how I wrap up. But if you had a crystal ball that worked, like you knew you were looking, you can actually see 10 years in the future. And Bitcoin was $1 million a coin. Mm-hmm. You factually knew that limited asset, the decentralized currency has kind of taken over, but that one coin is $1 million. And you knew it right now. What would most people do if they factually knew it? They would do what you did. They would get into as much debt as humanly possible to buy as much Bitcoin now to have it when it's $1 million a coin. Mm-hmm. Show me the time in our history we're in a 10-year period in the future, market wide, property values weren't higher.
Doesn't exist.
We don't need a crystal ball for the asset class. We trust the asset class. That's why you were able to go out and say, normally I have paid off cars. I enjoy not having a car payment. I'm going to get debt on this car because that asset is going to be worth more over time. This is why we're doing a video on the first 10 years, not the first couple of months.
Yeah.
I have a quick question for Zub.
Hmm.
Zub, knowing where rates are now today, because they're higher than both of us imagined, all of us imagined, right?
Mm-hmm.
Especially in the time, the velocity by which it happened.
Mm-hmm.
Do you wish that you had bought more deals in at the end of 2020 when rates were like 3 something for us? Because we believed it enough to refi our entire portfolios. But do you wish at that point, with what that pricing was, do you wish that you bought something at, that you could get a 3.5 or a 3.75 or a 3.95 handle on?
I have kind of an answer before you jump in, Zuber.
Okay.
Because I've heard you say it 17 times. Account. 56 flips in less than 2 years.
Yeah.
Wish you kept them.
Yeah, that's exactly where I was going. I think I got enough deals. I just didn't keep on. Again, I bought 56 properties. I did what I like to do. I took slumlord disgusting properties and turned them into something and sold them. I wish I kept them all. I didn't have to sell them.
Right.
That would have been, yeah. So Dion nailed it. I wish I kept them.
Yeah, because I think the mistake that I made is I didn't buy enough in beginning of 2021. I was euphoric about where the rates were. And, you and I redid our entire portfolios, cashed out, and got in locked rate debt. But I look at it and I said, you know what? There was probably another 7 to 10 deals that I should have bought. Where it just, you look at it, you're like, yeah, I could have. Those other 7 to 10 at sub 4 rate.
So yeah, I mean, when I look back at that year, I'm obviously happy with what happened. I spent most of that time either flipping those properties or putting fixed rate debt on my apartments, which today I look like a genius again, I've nailed lots of things in real estate. I actually had my eye on bigger things, and it did shock me how much more value apartments got because cap rates crashed, right? I sold an apartment, lost $500,000 because I sold it a year early. It still stings. So I got that wrong.
Yeah.
I still think I'll buy my biggest thing, if not this year, certainly in 2024, because the debt structure on some of these things are just horrible.
Well, so then that leads to the question, or kind of leads to the understanding that we have, which is understanding that when you have that performing portfolio and you're seeing all that money churn and you're seeing all that money basically just stack, it gives you the freedom. Like you're going to buy, like I've been saying it for almost a year. You're going to buy your biggest and best thing in the next 24 months.
I agree. Yeah, probably a couple, but yeah, I agree. That's where my eyes were. I wasn't looking on the next house on, right or wrong. That's just where I was.
The really great thing about real estate and investing is the analogy that I've heard you both use a couple of times, that there's a reason why your windshield is as big as it is and the rearview mirror is as small as it is, because when we look back, we can think of the things we should have done, right? But there are only 2 things that tell you when you should buy or when you should not buy. And it isn't rates, it isn't memory, it isn't prices. And if you want to find out what those 2 are, check this video out right here.
We're sorry, the number you have dialed is not in service at this time.